The rise of remote work is going to have great effect on government's ability to raise revenue through taxation. Before I go further into this, let me walk back my title a little bit. If governments do these two things, if governments implement hardline economic nationalism, and the federal government takes over a large amount of spending that was formerly financed at the state and local level, then the government has recourse to deal with this, and the government can implement government taxation spending policies in the same way they always have. But in order for the government to continue doing things as they have been done, the government is going to have to implement these two policies. And if they do not, then the government's ability to raise revenue through taxation is going to be greatly affected. So if the government does not do these two things I mentioned earlier, then the government will be unable to do anything else about the effects of remote work on revenue, and the ability of the government to be financed will be changed fundamentally by the rise of remote work. This video isn't talking about policy directly, but how changes like the rise of remote work affect the government's logistical ability to practically implement policies, and what policies are and aren't physically possible to implement. Okay, now that I've explained these points, I'm going to be talking about these graphs. This is a graph of federal tax revenue and state and local tax revenue. As you can see, state and local governments raise almost as much tax money as the federal government does. So half of revenue is raised at the state and local level. This is significant because state and local tax revenue are much more vulnerable to the rise of remote work than the federal government revenue is, because it is much easier to change locations to a different state than it is to completely leave the country. And it's much easier to change the county or municipality you're living in. Therefore, state and local tax revenues are going to be much more vulnerable to the rise of remote work than the effects on federal tax revenues would be. So if, let's say, 25% of employment is going to transition to be fully remote, then I'm willing to say that a very large portion of those individuals are going to be relocating to a different state or locality because they simply now have the ability to live anywhere they want, because their job no longer ties them down to one physical location. So there's going to be a huge increase of tax migration. And that is going to significantly affect state and local tax revenue. So there is going to be a huge impact on state and local government tax revenue. It is theoretically possible for it to decline as much as 60% as, say, 25-30% of individuals relocate from higher tax states to lower tax states. As you can see in this graph, a majority of revenue raised in the United States is done at the state and local level rather than the federal level. So if theoretically state and local tax revenue declined by 50-60%, then that would be a quarter of all government tax revenue that would just cease to be collected. Now, European governments are more centralized, but the size of European countries are a lot smaller, so it's a lot easier for people in European countries to relocate to a neighboring country than it is in the United States. So the two factors balance each other out in a sense. In the United States, the top 5% of earners pay around 60% of the income taxes. And about half of federal government revenue is derived from income taxes. So 60% of 50% is 30%. So 30% of the federal government's revenue comes from taxes on the top 5% of earners, the vast majority of which have now gained the ability to work fully remotely and live anywhere in the world while retaining their employment. Therefore, it's now theoretically possible for these earners to relocate to other countries and get taxed at the local rate, thereby causing the government to lose 30% of its revenue. Now, at this point, some of you may be thinking that that's not the case because federal income taxes apply to U.S. citizens wherever they live. And yes, that is technically true. However, what happens is that if a person relocates to another country, they don't necessarily have to be an employee anymore. They say they're something like a consultant or a freelancer, so they're self-employed. And if they're officially self-employed, they have a legitimate reason to incorporate. And if they incorporate in a different country, then that entity is paying taxes under the local corporate tax rate rather than the U.S. individual income tax rate. And so they own the corporation paying taxes under the local corporate tax rate, and a nominal salary that corporation pays themselves is too small to qualify for U.S. taxes. So what do you know? The income happens to just be taxed at the local corporate tax rate rather than the U.S. federal income tax rate. So yeah, people have to deal with taxes without having to give up their citizenship if they relocate to other countries. So it's now theoretically possible for U.S. federal government income to decline by 30%. It's physically possible now. And for state and local income to decline by 50%. I don't think U.S. federal income will decline by that much because I don't think every high income earner is going to relocate to another country. However, I do think a very large portion of people are going to relocate to states because there's always been a very high degree of interstate migration within the United States. So state and local revenue is going to get severely impacted to a very, very impressive degree. Now, as you can see here on this graph of tax revenue in the United States, by the way, the previous graph was on federal government revenue. This is total government revenue. As you can see, consumption taxes and property taxes make up a much higher portion of this graph because the bulk of state-level funding derives from taxes that fall on working people, like property taxes and consumption taxes. So the basic point of what matters is that even if only a small portion of high-income earners leave the country, the fact that it's now possible for them to do while they keep their existing employment means that it's going to be much more difficult to raise revenue through progressive taxation. If, let's say, the government increased tax rates by 5 percentage points, but 5% of high earners left, then suddenly the government's behind in terms of revenue raised, because the lower number of taxable people completely outweighed the higher rate of taxation, more than canceling out the effects and leading to lower revenue. So at the very least, this completely cancels out the government's ability to raise more revenue through increases in taxation on high earners. So income tax revenue from high earners is going to decline significantly. And state and local property and consumption tax revenue is also going to decline by a huge amount, leading to substantially reduced government revenues and the end of the ability of government to finance programs through increasing taxation on high earners. Now, as I said at the beginning of the video, there are some things governments could do to counteract these changes and return the tax revenue situation back to what it was before the substantial increase in remote work. If the government employed hardline economic nationalism and made it illegal to employ people in other countries, or for firms located in other countries to provide services to the population within the United States, then that would make it impossible for people to leave the country and relocate while maintaining their jobs. So high-income earners would remain confined to the country if they want to maintain their current employment situations and levels of income in that way. That would fully counteract the effects of remote work and return the revenue-raising paradigm for the federal government to its previous situation. Of course, the government could also enact huge exit taxes on wealth relocating outside the country, too, that are higher than the top marginal rates of income taxes, and that might also do something about the situation. But this means the government has to adopt hardline economic nationalism, which would be a huge shift in policy from the situation that has prevailed for the past 50 to 70 years. So it's going to take a while for that shift to happen if it does, and it's going to be extremely interesting to see such an about-face in the situation thing, after all this political acrimony about these types of issues. The other thing the government could do is for the federal government to assume the taxation and spending that used to be done by state and local governments. If the federal government did that, then it would negate the tax competition between states because there's only one federal government, and so to evade federal taxes, one would have to leave the whole country rather than just crossing a state or municipal boundary. So if the federal government subsumed the taxation and spending that used to be done on the local level, then that could return the level of revenue raised in government spending to pre-remote work levels and counteract the rise of remote work. However, the prospect for this I don't see as nearly politically possible. I mean, it theoretically could happen, but I don't see it as probable in terms of how likely it is to be able to pass muster politically. Because I just don't see the idea of a federal property tax or federal consumption taxes being viable politically. So even though it's possible in principle for the federal government to counteract the effects of state and local revenue losses, in practice I don't think that's actually going to happen, and there's still going to be a significant decline in state and local government revenue raised and spending, and ultimately I don't think the federal government is actually going to replace that activity and substitute state and local spending. I do think it's much more likely that, or at least it's politically possible, that the government will undertake substantial measures of economic nationalism to prevent economic activity from crossing borders. That is at least politically possible to implement, but it's still going to be a while until that happens, if it does eventually. So even if it happens, it will take a while. And in the meantime, there are going to be substantial effects on the federal and local and state governments' abilities to raise revenue. And that is going to substantially alter the ability of governments to raise revenue and the level of spending that we might see as a result of that.